For any investor, the core tenets of what they look for in a funding conversation is a combination of really these four factors of team, technology, traction, and market. How much weightage an investor attributes to an individual factor really depends on things like which stage are they investing at and what is the sector in question. So, for example, an early stage investor will pay a lot more attribution to the team, and given that there would be very little traction at that point, whereas a private equity investor would focus much more on market because they play in mature industries where there's a lot of sectoral data available on performance, not just of existing companies, but of peers as well. Similarly, a deep tech investor, on the other hand, would look at technology and try and understand what is your product-led differentiation in the long term. So it's very important that as a founder speaks to investors and paints a narrative, they cover these four fundamental aspects in that conversation. So let's talk about team first, because irrespective of which stage an investor is investing at, this really is the crux of the decision. What an investor is looking to understand is why you as a founder have chosen to embark on this particular journey. So very often founders we meet have made that choice coming from a very personal insight or experience. For example, Anil, who is the founder of Adda 247 and will join us for the second half of this session, will tell you why he started this business was because he came from a rural part in Uttar Pradesh and he didn't find enough opportunities to prepare for the kind of entrance tests that he wanted to appear in, which led to the founding of Adda. Or Gramophone, an agri-input and advisory business based out of Madhya Pradesh, has two of their four co-founders who come from farming background and have faced some of these difficulties firsthand, which is why they started this business to bridge that gap in the market. Even outside of social enterprises, you will find founders talking about those personal insights. For example, the founders of Mama Earth and Mom's Co will tell you that when they had kids, they found there weren't enough clean products in the market to use for their kids. And that's why they started, clean ingredients-based personal care products. So it's very important to share this aspect with an investor to get them to understand your perspective as well. This journey need not come necessarily from a personal background. It could also come from professional insight. For example, in the area of financial services or insurtech, we see a lot more founders who've worked with large banking or NBFC organizations and have understood in detail why those organizations aren't equipped to capture the value that's still left on the table, whether it's new emerging markets or product innovation. So either from a personal journey or from a professional insight, it's very important to cover why this. In talking about, whether you should be passionate about the problem statement or the solution, successful founders will tell you that there isn't any company which has managed to scale which hasn't undergone a pivot in its past, which often stems from the fact that when you start looking at a problem statement and you have V1 of your potential solution, as you take that product to market, as rubber hits the road, you will find that there are differences from what your understanding of the market was and what customers either need or demand. Hence, for us, at least as investors, it's interesting to find founders who are much more passionate about solving the problem with whatever it takes, rather than saying, I have a solution, which becomes, a hammer looking for a nail. The other question that we've had a number of founders ask us over the years is, are investors wary of investing in solo founders, right? Or is there a particular number of co-founders an enterprise should have? I think it's important to take a step back and understand why is it that investors may have such a preference, if at all, right? Again, as we'll hear from founders in the second half of this session, and what some of you would already know who are on this journey, that the path for an entrepreneur, right, is long and hard. Having a co-founder along the way can help you find someone to either brainstorm with in those moments when you as a founder might be feeling low, or have somebody who can take the baton from you if you're not, feeling your A game on a particular day. So for investors, it is not really about if one is the right number or 2 or 4 is the right number, because we've seen combinations of all sorts in the market, right? Vijay Shekhar Sharma is such a brilliant example of a successful solo founder leading such a category creating company at scale, right? Similarly, we have multiple portfolio companies where we have up to 4 co-founders in the company, all bringing different complementary strengths to the table. So the answer really lies in what works for you and making sure that your partners on the journey are people who have immense trust and faith in each other. Because as founders leading teams, the teams will need to know who the buck stops with, right? So the question founder investors often have to teams where there are 4 or 5 co-founders is make sure that decision matrix is clearly narrowed down internally, so everybody has very clear understanding of which are the areas they're focusing on and leading, and that understanding translates further into the teams as well. Moving on to the second critical aspect, which is market. So this is another area where investors will spend a lot of time, both in talking to you as part of your pitch and doing their own secondary diligence. Let's break this down into what are investors looking to understand, when they say, let's understand the market that you're targeting. One, it's important for founders to put themselves in the investor's shoes and ask that question of, is this market large enough, right? That's one of the big questions you'll get. It's important to break that down further into why is it that the investor is asking that question. Venture capital or private equity, for that matter, works on a principle where there is a very high mortality rate for startups who are at an early stage, right? We as founders, we as investors have seen this play out over very many years. There are enough statistics that say that no more than 3 or 4 companies out of 10 that start out on a journey make it to any sizable scale. So when investors evaluate market sizing, what they're looking to understand is 2 things. A, is your understanding of the market nuanced enough? Are you doing sort of a top-down estimation of the market to say, we believe this is a $50 billion opportunity, and if we could capture even 10% of it at $5 billion, it's a large enough market opportunity for us, right? I think that to an investor will say, maybe you haven't spent enough time understanding the fundamentals of this market. So it's much better if founders approach market understanding or market sizing from a bottoms-up approach, saying that these are my initial set of customers and this is the kind of value per customer I can capture over the life of my product deployment. So as we size a market, what we then get to is the second critical aspect, which is this market large enough? Because what investors are looking to understand is that if everything plays out as per initial estimations, whether it's you, whether it's the investor, is a successful outcome good enough, right? If the successful outcome looks like you being only a 100 CR company at the other end, or playing in a, let's say, 200 CR market, then the exit opportunity for an investor gets capped, and hence the end outcome then ends up being capped. So 3-4 of the portfolio companies in a 10 company portfolio delivering 2x outcomes would still not move the needle on an investor's fund. Hence, please spend time understanding your investors' fund economics as well. And it's absolutely okay to ask these questions to your potential investors as well. That what would be a good outcome for you, so that you also have good alignment at the outset, that if you think the pace of growth for your business should look like, let's say, a 6-7% CAGR over 5 years, would that be good enough for your investor as well? Because you don't want to end up on different pages down the road where you have competitive pressure from the investor to grow faster, to deploy capital faster, and your goals for your company are very different to that. The other critical aspect to understand here and talk about in your fundraising conversations is growth drivers, right? For example, when we invested in a commercial vehicle financier last year, one of the big growth drivers that we saw in that market at that point was that the government had recently introduced a scrappage policy. What that meant was that vehicles more than 15 years of age would go out of market, hence creating greater demand at the top of funnel for new vehicles to be bought and funded. Similarly, Sandeep, who leads NEPRA, which is the waste management business, will talk about some of the fantastic regulations that government has introduced in that segment, which have created such tailwinds for his waste management business. Not necessarily always regulatory-led. Growth drivers could also be about tectonic shifts in the overall private sector market as well. And the biggest of these in the recent years has really been the drop in data rates in India, or the internet penetration getting into, which is now a 400 to 500 million user market from what was a 50 million user market about three and a half years back, right? And Geo has been that big factor. We've seen multiple companies use this for disruptive business models, which could only be created on the back of this kind of evolution in the ecosystem. The other couple of aspects which you should consider as you structure your pitch decks is, what is your long-term moat, right? Because as investors study markets, they will also study your competitors. Very often, what problem statements you're going after will have other players who are already in the market, maybe with a different approach, maybe on a smaller subsegment of the market, maybe a different geography. But investors will assess this from a longer term and say, well, this competitor may only be in, let's say, Bombay today, and you're working in Delhi, or let's say in the case of impact businesses, you're operating in Bihar and the competitor may be in UP. But in a 3 to 5 year time frame, right, some of these boundaries will start disappearing, and you will start operating in each other's geographies. So what really becomes your long-term moat, whether it's distribution or its product, it's very important to make that competitive advantage stand out in these conversations, because that's also what will lead to value accretion in your companies and create great exit opportunities for investors. Similarly, since we're talking about social enterprises, it's also important to talk to investors about, if you have successful outcomes, how is that collinear with great social impact delivery at scale, right? And at least in our view at Asha Impact, great impact businesses are those where financial performance and impact creation go hand in hand. So if you scale, you're able to deliver value, whether it's improving access or improving affordability for your target segment in essential areas of healthcare, education, financial inclusion, agri-businesses, livelihood creation, whatever your impact goal may be. It's important to have collinearity with your commercial goals as well. Moving on to technology, and before we talk about that, if folks on this folks on the call today have any questions along the way, please feel free to send them as I speak, or we can take them in the second half of the session once we have Sandeep and Anil also joining us. But feel free to chime in at any point. So technology, right? Why is this so critical in the valuation of any investor and any enterprise? We believe as impact investors that not just for the typical technology-led venture capitalists, technology is a very critical aspect for impact investors to also look at, because very often the problem statements that companies are going after today are age-old in nature, right? If you're looking to solve problems in, let's say, an agribusiness or for a farmer, those problems would have existed for decades. So why do we believe that it can be solved today? And very often the answer to that will lie in technology. So it could be technology as the core product. For example, we've invested in a medical technology business called Jana Care, where their core product is a radically innovative device which plugs into any mobile phone, and it has an OCR reader which can read the chemistry of different strips which act as consumables. That has reduced the cost of doing an HbA1c test by about 3x, and also given that power in the hand of a GP rather than just the diagnostic labs. So is your advantage fundamentally new IP, or is it use of technology in the business model, in how you're delivering value, which helps you get an operational advantage? For example, Gramophone, which is an agri advisory and inputs business, uses technology very effectively to onboard farmers digitally on their solution. What that does is that they're able to service farmers in remote areas in Madhya Pradesh, far from the Indore and Ujjains of the world, because they don't need to spend on putting feet on street to onboard those farmers. So we're able to reach farmers, which we couldn't have done in the past if these farmers were not using smartphones or using, reaching out to access communities, reaching out to access agri inputs through these new kind of models, which really is something that's possible because of the greater internet penetration. So make sure you've weaved in technology as an important aspect of either your product or your delivery. Otherwise, it would be hard to understand why this is an innovation that's time is now. Moving on to the fourth aspect of traction. And this again can be such an interesting one, right? Because we have so many founders who reach out to us saying, do you look at businesses which have at least 1 CR of revenue or 50 lakhs or 5 CR? What's your benchmark? So it's important to understand what does an investor mean when they say this business may be too early for us or too late for us in rare instances, right? When we say we want to see adequate traction, the investor is looking to understand 3 or 4 core aspects, and let's talk about those. One is really founder tenacity, which means that is a founder committed to the cause, right? If we have founders approaching us who are still to quit their day jobs and are looking for an investor to first validate the idea and put some capital on the table before they make this their full-time, passion, I think that for an investor can be a big negative, because our conviction in a business will always be secondary to a founder's conviction and vision. So can we make sure that there is some demonstration of a founder's tenacity and a founder's grit and passion for the business when you start engaging with investors in these conversations? Then come the slightly more financial aspects of traction, which is what is the unit economics of your product, right? For example, if you're an e-commerce business selling, let's say, artisanal goods, how much do you make on per transaction? Are you spending so much to acquire one customer that you need them to do 4 transactions with you to make money? Or do you break even in the first transaction with them? If this takes many more transactions, then how do you engage the customers to stay with you and transact with you over a longer period of time? So unit economics is very important, not just for investors to understand, but for founders to understand, because it will also directly impact how much capital you need to plow into the business to get to a certain scale. So what becomes the right amount of capital for you to be raising at the outset itself? Similarly, when we say product market fit, right, this is again one of those elusive concepts that investors talk about and founders may often not have a clear understanding of. Very simply, product market fit refers to your product finding customers who love the product, who are buying the product or service and are paying for it. Now, there again, how many customers one has and how much they're paying for it is something that can evolve and is contextual. What's the product or service? What's the price point? What's the geography? But it's make sure that you're only investing larger quantums of capital in the business once you know that there is product market fit. The final point on traction is really capital intensity and paths to profitability, right? I think as founders should always have an eye on what's the capital intensity of the business, because it also speaks to how much dilution there will be in your holding in the company as you raise external capital. But more importantly, it also tells you how long the journey to profitability looks like. And in the current market environment, you'll have enough investors asking you those questions. So make sure that any plan you present to investors or any plan that you as a founder are tracking has a clear visibility on when do you break even, how do you become profitable, what is the level of profitability, and how does that compare with peers if you have any in that industry. So having said this, this broadly covers the four key aspects of team, technology, market, and traction. I'll go through some of the questions that we have coming in, and then I'd like to, invite Anil and Sandeep, who are two stellar founders who've made the time to join us today. So Raghav has a question that I have a stable business and I want to grow, but VCs tell me mine isn't a VC fundable business. What does that mean? I think it's a very important question because alignment between founders and investors in the long term is very critical, which means that if you think your market is niche and you want to build a highly profitable business around that niche market and don't require external funding, you shouldn't be looking at external capital, right? And there are businesses which meet that criteria and there are businesses that don't. So having nuanced conversations around this is extremely critical. We have another question around how founders should treat rejection, but I think that's a question we'll save and ask the founders on our panel. We have another question on the new education policy that's been announced by the government and whether that can be a tailwind for EdTech. And again, we'll have Anil take up that question. And yes, we will be sharing the presentation at the end of this session. So great. Let me now introduce Sandeep and Anil. Sandeep co-founded and is the CEO of Let's Recycle, a category-leading business in waste management, a highly unglamorous area to be working in. So quite a trailblazer in that field. And we'll dig deeper on that. And Anil, who's the co-founder and CEO of Adda 247, again, absolutely, great business focused on mass markets and students who are preparing for government job and come with the aspiration of, cracking jobs which can provide some stability to really a massive aspiration in India's, hinterlands. So I'll stop sharing my screen at this point and we can start with the panel discussion. So Sandeep, Anil, thank you so much for making the time to join us today for this session. We hope that at the end of this chat with the two of you, founders on this call can walk away with a greater understanding of what the journey of a founder looks like, not just in fundraising, but in running businesses at scale as well, which both of you are doing so well. So Sandeep, let me start with you, right? Waste management, dealing with kachra. What motivated you to pick up such a hard segment when you started this business almost a decade ago? Sandeep, you'll have to unmute yourself, please.
So as entrepreneurs are supposed to take the unconventional road, I took the same one where, when I came back, I'm a first generation entrepreneur, right? So firstly, it's a challenge itself as of a mindset change that, your family, your father has always worked in a job which is quite secure. So there was a complete mindset change for us. And initial days when I was, really exploring stuff, what I see was everybody was running in one direction. And I am a person who always goes in the opposite direction. So I tend to take a different path all the time, saying, why go with the crowd, try to do something different. So I used to do that, but mainly I could find from my experience in industrial waste and all that, where there was lack of transparency and trust in the whole value chain. And that's when I started exploring the dry waste. And everybody was saying it is impossible to do. So when somebody was saying it is impossible to do, I felt it more as a challenge to go behind it. So it took me about 4 or 5 years to really go through the value chain from 2006 onwards till 2008-9, when I started trying it out, what I had experienced and learned. So I think all my earlier experiences helped me, all my failures helped me survive. And luckily, before I could die a natural death, I was lucky to have a coffee with one of our early investors, Avishkar. And we were almost on IV fluids when the first round of funding came in. So that is where, it was about surviving a lot of downs, I would put it as that way. and going against the routine.
Got
That
it.
became a challenge.
I think that's great, Sandeep, and it's so good for founders to hear that they shouldn't be following trends. It shouldn't be about investors are today looking to invest in, let's say, digital healthcare. Hence, let's quickly start a business in that. Founders will be the ones who spot opportunity earlier, and investors should follow rather than the other way around. Anil, let me come to you. Again, you started Adda because of a very personal experience. So, talk to us about that and also tell us that you ran Adda as a bootstrap business for a very long time before you raised external capital. So, how did you figure that it was the right time to start seeking external partners?
Thanks, Aditi, for inviting on this panel, and I can very much correlate on a lot of thoughts with Sandeep. In the journey of an entrepreneur, there are lots of ups and downs, and it's a very challenging journey. So two, three things, Aditi, which you have asked. So first one is there has to be some reason behind your startup, right? Whatever you are doing, there has to be some logic, something compelling which is pushing you into it. For example, I was working in Cognizant and in a decent position in corporate in 2010, and was supposed to go to US at the time. And somehow inside me, I felt that no, I don't want to go to US. I had come from a rural background, and I had a lot of strong feeling that probably one day I would like to do something for these guys. Very strong feeling. So when it came to moving to US, then I realized, yeah, this is the time when I have to take the call. Because if I go to US, then I'm not going to come back. Because that was the experience which I could see in context of most of my friends. Whoever went there, they never came back. So for me, it was like I had seen that kind of problem sufferings down there, and I really thought that whatever I can do, but I would like to do something. So keeping that in mind, I started this business where we said that we want to help tier two, tier three students, aspirants rather, who are looking for jobs. And one of the biggest opportunity for these guys in government sector. So we thought that let's help these guys in getting jobs in government sector. Coming to the second thought, Aditi, which you asked me about the funding part. So my belief always has been that funding is something which you should think as a secondary thing. Secondary means you should not start the thought process with the funding. For example, when you are thinking of your business idea or your product, it should not start with funding. Funding will follow. It cannot be the first thing, and it cannot be the measure of your success and failure, at least in the beginning. So for me, I had a co-founder with me, Saurabh, and we started working on this whole idea. And interestingly, for 5 years, we did not raise even a single amount of money from the market, zero funding. And we could build around 20, 30 crore kind of revenue and huge ecosystem all across India. We had almost 80 physical branches where we are guiding almost lakhs of students on a yearly basis and absolutely zero fundraise. But then there came a point where we said that, yeah, our audience is tier two, tier three, and those guys are not able to attend these classes in bigger cities or let's say where we had our centers. So now we want to reach out to them in tier two, tier three or villages. So now technology is the way. And when it comes to technology, it's not so straightforward. You have to invest a lot in your product, right? You have to visualize and you have to take care of all kind of requirements around it. For example, when people are going to access your product in a village, then there is going to be a problem around network. Internet is going to be slow. Their devices are going to be poor. They will access it from mobile. So a lot of challenges are there. So when you are visualizing a product, then you visualize about the team, about the investment around it, and then funding comes into picture. So for me, funding came into picture at that time when we were thinking that uh, we are on a mission, and now at this stage, new dimension has opened up. Internet is there, Reliance Geo is there, people are using mobile phones, And probably now internet is the best way to reach out to those guys, for which we started this whole thing. At that time, that was the time we raised our first funding, and so it followed. It was not the first thing. We even did not think of any funding when we started, but later on it followed.
I think that's great, Anil. The focus on being bootstrapped as long as one can be, right? And you thinking of funding as a secondary goal rather than a primary is so important. So, on the same line, one of the things that as an investor stands out for us when we look at either NEPRA or Adda is that both of you have built your businesses with such a strong focus on bottom line and bottom line growth in parallel with revenue growth. So in a market where founders read stories about rising valuations every day and hockey stick growth curves, how do you maintain that DNA as a founder? How do you align your teams to think similarly as well? And Sandeep, maybe you can start, and then Anil would love to hear your thoughts as well.
See, so it's always about the journey and the timing and when you get the money, right? And what kind of investor you get on board. So we always had a tough time getting investors on board, because I remember in 2008 I used to reach out to a lot of investors. I reached out to almost 68, and all of them said no, that we don't invest in the sector. So you can imagine the kind of journey I would have gone every day, having one kind of somebody saying no and going to sleep, and next day again waking up and saying, chalo, we'll try somebody else. So 68 people had said no, and of which another two I had a coffee with, which was coincidental again, but one of them moved fast and invested. That's Avishkar. So that's a unexpected investor which I had. I never thought we were a social enterprise till they came and showed us what exactly the impact we were making. So I was always thinking commercially about this business being there. Our business is based on unit economics, because every paisa counts. But definitely we have seen a lot of downtrends also while going up. So we value money quite heavily, because it's an experience which takes you through survival. So definitely for us, it has been on a bottom line focus for always bigger. But we also understand we are in such a space that there are ups and downs because of various parameters. So we use technology to a great extent. So we try to de-risk the model as much as we can. So as an entrepreneur, our focus was always been about de-risking the value chain, de-risking various parameters, preempting a lot of stuff, trying to control wherever we can, making the information available to our members to ensure that their costs do not overrun. So we have been trying to do that, but definitely, the growth at one point of time was not hockey stick, but definitely there is an opportunity to go that way. But again, we have control. We have various ways of controlling that as well. So we are doing that.
Got it. And our favorite story about you and Dhrumin, your co-founder, is always how we will argue with us down to the second and third decimal, saying nahi, ye nahi round karoge, this matters. So that kind of focus on unit economics and profitability.
To add to that, definitely the team and the co-founder is an equally important part, because he's a guy who remembers up to the decimal point, and he can argue what impacts where. Whereas I look at the larger picture, so I'm more relaxed because he looks at that micro level.
Exactly.
What about you? I mean, I know Saurabh plays a similar role.
Exactly similar. So yeah, that reminded me of my co-founder only. So I think my feeling is that business is all about money, right? Why we do business? We do business so that we can earn profits and we can reward our shareholders and we can even reward ourselves. So I think that's a basic hypothesis. So it's very recently when funding has a lot of hype and overtaken a lot of basic fundamentals of business. But I believe that businesses should be all about profits, and unit economics matters a lot. As I said, for us, we even in the beginning, first 5 years, we never thought of funding. We thought that we are going to build something profitable. It's somewhere down the line when we realize that we need to invest in technology and we are working on a product, and for that particular thing, we need money. But otherwise, what I feel is that uh, if we are not, so again, that also depends. So in some cases, what I've seen is that money can play role where you burn in few years, But those are specific cases. I mean, if we talk of generalized and we talk of generally starting a startup and generally growing, so there may be some cases where actually funding plays a key role in the beginning or the initial years, and it leads to a lot of burn and a lot of losses. But eventually, unit economics of the business justify that, and later on, that is going to compensate. But if, as a business, you are able to foresee that what kind of unit economics will be there eventually, I think that that should be the call. And in most of the cases, especially service industry, many other segments, there is no requirement of burning money or incurring losses in the business. So for us, I think money matters a lot, and we want to invest every penny in the right direction, because what we feel is that money is the biggest asset with us, which we have to utilize wisely. And eventually that pays off also. Because if you come to spending, let's say you have a lot of money, then there are so many ways to spend money. Money will just come and go. But if you are spending wisely and you are utilizing every penny, then more value will come out of it. And it will be a robust business rather than uh, hockey stick growth on the basis of funding.
Got it. So let me follow that up with a question we've got from the audience saying, Anil sir, how were you able to build a unique brand in an offline setup, especially as you were bootstrapped? And most people feel that scaling businesses offline requires a lot more capital than doing it online. So how did you do that in the initial years?
Right. So offline is, yes, it's totally different from online. So currently we are completely online business, but 5 years back we were completely offline. So we have been through that transition. Offline is a lot different in many sense. First of all, it's a lot about the connect with the real human. So what happens is that when you have a physical setup, then lot of businesses around walk-ins. People come to your ecosystem or your center. They personally talk to you. They talk to your people, and then the connect is built. So in our case, two things worked. First, because me, Saurabh, we were already there, and we were on the front of every activity, either interaction with the students or even teaching or even content generation. Means whatever we were doing, we were heading almost everything, and we were directly involved in every sense. So that worked a lot. And secondly, the kind of your concern towards quality. So for us, the quality was success of students, and to what level you go to make it happen. That matters a lot. And in offline, this is quite visible as compared to online, where you see just a website or a app, but behind the scene, what's going on, people are not able to see a lot of times. But when it is offline, then people see a lot, because then it's a small community, or let's say small geography. People know you, they start knowing you, they start seeing your efforts, appreciating your efforts, and it becomes kind of, you are able to build trust very fast if you are genuinely working and genuinely aligned with the success of your customers. In our case, it's the student. So I think that worked. In fact, we, again, in offline also, we hardly spend any money on marketing and advertisement and all. We did not spend money. What we spent, our resources were to ensure the quality, to ensure the add-ons to what we can provide to our student to make them successful. We were, in fact, we went to that extent that we used to talk to their parents and their families also. We used to tell them, okay, your son is doing this and this with us, and for last 1 week he has not come to class. And suddenly parent will feel, "Arey, ye kya ho gaya? Nobody tells me ki is level pe, like the guy is graduation or he has already graduated." So it's about that building connect and putting efforts in the right direction. So building trust in the community is relatively easy. The problem comes when you are scaling, right? You have a one branch in, let's say, Delhi, and you are opening other branch in Chennai, and then there are so many cultural changes, so many things, and most probably you might not be personally there at that location. So how you maintain that, and how you are able to give the same quality and experience, and how you transfer that DNA which you have in Delhi, how that DNA is transferred to Chennai. It's a challenge. Actually, it's a challenge, and somehow we did it because we believe that in these two three things, that personally you have to be there, and you have to understand that ecosystem, and you have to act according to it. Because if we look at the geographies, sometimes the behavior, user behavior and expectation, they slightly differ with respect to small experiences.
That's very helpful, Anil. And clearly, you guys did such a fantastic job of it that as you've migrated online, the brand that you've built in the offline world, in these remote areas, is what's made you, the category leader in terms of people who know the brand, and students want to still come to Bankers Adda, SSC Adda, and all the properties you've created. So let me go back to something that both of you alluded to in your previous answer, which was really the role of co-founders, because this is something that founders again struggle often with, the question of should we have a co-founder, how many co-founders should we have, what should be the kind of relationship and power dynamic between the co-founders. So Sandeep, talk to us a little bit about your relationship with your other two co-founders. I know both Rumin and Ravi Bhai play such an important role in the organization. So what do you think has been the secret sauce of the amazing chemistry that the three of you have?
See, I think knowing each other's strengths and weaknesses are something which always helps in a relationship. And co-founders relationship is similar to that, where you accept each other's weaknesses and try to complement those things. And I think as a team, you have met and all my co-founders, we complement each other's weaknesses. So something which I'm not good at, I definitely am confident Dhrumin is doing an amazing job on that. And Ravi Bhai has always been a support, quite pillar standing behind, a strong pillar. So whenever we need any kind of fallback, he's there. So I think accepting each other and who does what is also equally important. So there is no conflict on thought process. Because I think I was listening to your comment also, who is the where and how they are taking decisions is equally important. There must be a conflict between leaderships as well. So luckily, as a team, we accept each other's strengths and weaknesses, and we own up to our roles and own up to our mistakes or our responsibilities. So I'm lucky to have a team where, as a CEO or as a leader, I do not get contradicted much and get support from everybody. So that's where co-founders come into play. And it's all about trust. So end of the day, is the trust or the faith which a co-founder needs to have on the decisions of each other. So while historically we have made mistakes during our journey, we never pointed fingers at each other saying you made this mistake or I made why you made this mistake, and getting into the blame game. It is more about learning from those mistakes and how we can make a better process or a policy about strengthening our understanding between us, so that people don't take undue advantage. Because trust me, sometimes it does happen during the journey, is lack of communication or increased communication gaps does lead to misunderstandings, and that is where a lot of founders start disagreeing or moving away from each other, which I have seen in other friends companies as well.
So I think trust is such an important piece. And again, an anecdote from our conversations with you. When I speak to Sandeep, who heads most of the finance aspects of the company, Sandeep will tell me, if I ask him anything on operations, he'll tell me, call Dhrumin. Operations is Dhrumin. And initially, I used to get irritated thinking, since I have you on the call, why can't you give me a 2-minute update on the business as well? But maintaining that clear demarcation and respecting each other's, area of expertise or whatever the other person is responsible for or leading. I've seen you do that with such precision and consistency that I think that's a great lesson for founders.
Comes from experience. We have our own experiences internally, so we try to bring that bifurcation as well.
Kudos to you for pulling that off and teaching us. Anil, what about you? I know you and Saurabh have such a great working relationship, and in the past, in the offline model, you had very clear-cut demarcations again on who looked at what. How has that relationship evolved as the business has moved into a more cohesive online-only business?
Right. So the one of the thing is, personally, I used to believe that I cannot work with anyone before I started this business, and that's why I started all alone. On day one, I was alone. because I thought I have very, just like Sandeep said, I am ulta. When somebody is going on this side, I will go to opposite side. I will always question everything here. Why this? Why not this? And so what I saw in my all school and engineering times is that I had very sharp and very smart friends, but most of the times I am fighting with them, on arguing with them. So anyway, so I thought that I will start it eventually alone. I started alone. Instantly, within a month's time, met Saurabh for the first time through a friend, and he also wanted to do something. So I said yes. Somehow I said, "ठीक है, come on, आ जाओ, let's do it together." But now I believe that was one of the best decision for this business and for me, which I took, because what I have realized in the last 10 years is that entrepreneurship and this whole journey is very lonely journey. They always say that there are going to be so many ups and downs, so many things are going to happen uh, with respect to customers, with respect to employees, with respect to investors, a lot of things, right? So if you don't have a co-founder, then actually it's going to be very lonely. So now I feel that if I had I not been any co-founder, then it's going to be tough. Having said that, I think the biggest thing is the trust which you build with each other. And so, for example, right now we have me and Saurav have clear demarcation. I work on something. So for bigger, as Sandeep said, for me, task is the bigger picture. So mostly I will look at the business, or I will look at the picture for 2 year down the line, what's the vision 5 year down the line, and how we are aligning ourselves to that, how as a company we are moving in that direction. But then if you are focusing on those things, then there are a lot of things at the back which you will miss out definitely. Because then day-to-day operation has to happen, there has to be a perfection, finances are there, you have to make payments and you have to optimize on costs, so many things which will miss out. And in my case, those gaps are filled by my co-founder Saurabh. So I am always clear that okay, if it is about cost, payment, anything related to that, Saurabh is the person. And if we are talking of anything, how it is going to evolve, how we are going to structure, what is the strategy, what is the vision, how we are going to meet those goals, then I think I can play a bigger role, because then I am into it. I keep on talking to people, internal, external, and keep on refining that. So, and the most important thing is trust. We are able to trust each other to that extent that Saurabh can take any decision with respect to his area. In fact, with respect to not even his area, for anything related to company, he can take any decision. And same, he trusts me. I can also take any decision. Incidentally, in my case also, this is the case that there is so much trust in the leadership team that people believe and people trust. So lesser arguments, I will say, which is big comfort, because you have so many friends to fight, and if team is aligned with you, then it's a big positive for you. But ultimately, being a co-founder, I will suggest everyone, people who are thinking of starting a business, think of a co-founder. But my experience is that it's a chance that you will get a good co-founder. Again, it will depend whether the person has same kind of aspirations or skill set like you. If this is the case, then there is going to be conflict. uh, Most important is your skill sets and your aspirations, your strength weaknesses, they have to be complementary. If they are on the same line, you are going to end up arguing a lot, which I see in a lot of startups, and a lot of startups fail because of this. There were two good people or three good people, अच्छे थे बहुत बढ़िया, but they could not make it just because, and they were smart, but all of them had same strength or same aspiration, same aggression. For example, in our case, I am very aggressive sometimes. I think aggressive in terms of approach. If we want to do something in 10 days, I will say do it in 2 days. There Saurabh comes into picture. 2 days is not possible. Let's so come somewhere in between, and then the team gets aligned. So I think that kind of balance is required.
So essentially, Anil is saying that it's a relationship of a couple who are married, so they have to be complementary to each other because
Right.
they spend more time together than husband and wife.
Exactly.
Very, very interesting. And related to this, we have a question coming in, which is the equivalent of should you have a prenup? Because we have Sachdev asking us how important is it to have a formal founders agreement and at what stage?
See, we never thought on those lines, frankly, as founders. Reason being, if your objective and goal is similar, and you had a clarity of understanding between what the whole relationship started with, of the structure and all that, and if you stick to what you discuss, then I don't think there is much need of anything else. Because, and another part in any relationship for that matter, either it is a founders agreement or a real life relationships, is sometimes letting go. Letting go is also an equally important trait which every individual needs to have, and it is reciprocative in nature. So if I let go certain things, he will let go certain things. So it's an reciprocative nature of relationship, where you don't be rigid on a lot of things. You accept, as I earlier also said, it's about accepting mistakes or weaknesses or anything. So it's similar to a married life as well. So you have your own challenges, personal disagreements, and all that, but you need to accept those things and move on. So I don't believe in agreements as such for founders as such, but definitely with investors you should have very good agreements.
Correct, because investors will tell you hope for the best but plan for the worst. So have the agreement in the background in case.
So see, investor relationship is a contract marriage. That's how I would define it as. So it will end at one point of time when you give them a good exit or an opportunity to exit. So it's a contract marriage where it is completely depend on the contract. So what's defined in there? So there, I would advise always founders to, I have learned it late, but when we started, when you guys came in, you taught us a lot of things to get into detail, and since then we have been learning our ropes. So definitely trust is an important part, but definitely at certain juncture of your journey, you also need to understand it is important. If it is required the way business is growing, then definitely you should have even founders agreement if need be. So it's about what stage is the right one is something which you need to really look at. So I wouldn't say any agreements are required on day one or need to be very rigid, or even investor agreements on day one. But at certain point of time, you need to see what you need to let go and what you do not need to let go.
Yeah, so my feeling is slightly different here. Uh, my Whatever I have seen in last 10 years, I believe these agreements should be there from the beginning. This is my personal experience around what I have seen. Although, frankly, between me and Saurabh, there was no agreement. We did not make any agreement. It was just like Sandeep was telling. We we came when Saurabh came on board. So we just said that we agreed, and we even did not do anything in written. We initially we have in fact we created a small partnership agreement. It was about partnership, that it's a partnership firm, but between us there was no kind of agreement. But what I've seen is what I have in these 10 years, when I see a lot of my friends and a lot of other startups, what I realize is that when we start together, co-founders, then at that time there's a lot of excitement, a lot of positivity around the startup, and we start on a very good note. But when we start doing the business actually, so let's say next 2 years, they are going to be very tough, and there is high possibility that somebody is going to break down. There is breakdown. There is high possibility that one or two of you or any of your team member might break out, and they kind of realize that this is not my cup of tea. Because when we see from outside, startups are very lucrative. They are very shiny and very kind of attractive things. But actually, when you go into it, it's not that easy. It's going to be very tough journey. At least in the beginning, it's very tough when you are all alone. So, for example, in our case, when we started, so of course there's a lot of positivity. We had some saved money. I had some money. Saura had some money. With that, we created infra and started doing it. But after 6 months, the money was over. We spent all the money. Then we started borrowing from the parents and relatives. अगले 6 महीने भी निकल गए. What next, right? Then you start feeling, and what happens is that we come, for example, in our case, and most of the cases, people come from good background. Either they leave good jobs, or they come from a background of IIT or IIM, something like that. So they know their opportunity cost also. So when they are going through these tough times, then there is a possibility that there might be a breakdown. They might realize that this may not be personal also, this may be related to family also. Because there is a family behind every person and you don't know who is behind the other person. Maybe there is a wife, there is a mother, father, sister, daughter, financial implications. There may be so many things, right? So if you don't have that agreement in place, then there are going to be a lot of problems later on. And it is very, I will say, uh, for a founder, it becomes very torturous kind of thing. Personally, what I feel is that when you are when you are together for 2 years and you are working very hard and you are living those tough times together, and then suddenly, due to some compulsion, somebody has to leave at that time when it comes to those discussions ki now what's going to happen, what's going to happen to my shares, or whether I am going to leave everything, whether it's going to belong to you, or what happened to my 2 3 years which I put into the business. There are a lot of things, and which is the I think which is the objective behind this agreement, where there is a clear understanding that tomorrow if something happens, then this is the way forward, so that later on, because we cannot visualize those scenarios that tomorrow what's going to happen, right? You can never imagine. So personally what I've seen is that in tough times these situations come, and these discussions can become very tough when you start having those discussions that okay, yeah, tell me, yeah, these are the compulsions. For example, my mother has so many problems or a financial problem, I want to quit, I want to leave, and then it comes to that kind of discussion, negotiation. It's very tough, right? You on one side you are emotionally attached to that person because he has been with you for 2 years, he has helped you build and bring business to this level. Although you still believe in the business, you have full faith and you are going to continue, but you are at the same time also giving merit to this guy that okay, he worked hard along with you, he was there with you, and today he is going due to whatever reason. So there has to be some understanding कि यार तुम जाओगे तो what's going to happen. So I think it's better that we decide it in advance, and so that it's everybody has complete clarity, and any eventuality comes in the future, there is no conflict. Although personally in my case, we did not have any kind of agreements, and probably tuning was such a good tuning that we never realized that we needed. In fact,
But
the
Anil, I think to align to that, what I normally believe is the agreement, which basically documents a lot of crisis situations which might occur in the future. Probability is we might never be able to cover all of them. So what you did or what I did was mainly about looking at a situation and what is a right decision and wrong decision. We have taken that decisions on those bases, because there will be times where something you have not documented and the situation will come. So as founders or as co-founders, what is your ethical thought process? You must have taken those decisions as well. So what is the right way of handling it and what is the right way of doing it? So if something is not in interest of business, you might say no. But if something is in interest of business while taking care of that particular situation, you might have to agree to. And definitely, the real color really comes out when there is a crisis. So definitely, any co-founder who stands with you during the crisis is that right decision at that day. You feel that you made that right decision and you are able to confront and fight together that journey or the crisis.
I'm so glad we covered this in depth, and we had contradictory views on the matter to begin with, because this clearly touched a chord with a lot of our participants. We have, questions which came in on that. How do you manage the shareholding in case such a disagreement happens? How much is self-awareness important for founders and co-founders? And at what stage should you have this agreement built in? So I hope it answers these questions, Sumit and Akash and a few other people who asked us about this. We have another interesting question from Niranjan, who says that we talk so much about how do investors make the decision of which startup to partner with, but how should a founder think about this? How should a founder choose their investors? And both of you have very diverse set of investors that you worked with over all these years. So talk to us a little bit, about that. Sandeep, maybe you want to talk about your experience? How did you make the choice, and what do you think are important parameters for founders to look at when making that choice?
So as I said earlier, I never had a choice, right? So it was more about the 68 saying no, and then we are almost on the verge, and you go and meet somebody to have a coffee just as a casual meeting, and you have a dialogue for 6 months, and then you have two people who are talking. But see, at every stage of business, you need to define what kind of money you want to take. Because personally, when I was building this business, we had a lot of options from friends and family who are into construction sector or any sector who were ready to pump in money. But as an entrepreneur, I knew wanted to raise institution capital, because the way we are, the sector in which we are, we need to really think differently. So I refrained from taking those kind of money. We tried to pull in as much as we can. We almost went bankrupt before the first round of money came in. So it is important to define, does your DNA match with the kind of so as similar to what I mentioned about co-founder or a investor, DNA needs to match. So when you talk about hockey stick growth, there are certain investors who are more keen on that hockey stick growth rather than building the foundation. So what kind of strategy as an entrepreneur your intentions are? Do you just want to create hockey stick growth and then exit, or the sector which has those kind of profiles? Unfortunately or fortunately, both ways. I think today when I look at it, it's fortunately. 68 said no, two said yes, and one came in, and then they have continued to back me through all ups and downs. Because their expectation from this industry was similar to what it was about creating a different niche, and then you guys also joined with the similar mindset. So it allows that alignment of building and making that impact, that this is what exactly we all want to achieve, and that gives you that space to really take those decisions on building those foundations and blocks. Because organizations or any building has to be made on any foundation. So that journey of creating a strong foundation is equally important, and that is where investors play a lot of role. I have seen a lot of companies with hockey stick growth having working on Excels only, and then they start building on softwares and process, and where they collapse culturally. So it is important that you should get that time, and the I think importance of that investor profile is equally there, where they give that kind of perspective on the business model, process, or the tech part, or the people part. Especially means from my journey, it has always been about people. No doubt our process are always designed to take care of people in the value chain, and we always believed of doing it in the right way. But luckily we had investors who also believed that. So even during this COVID crisis, you are aware, we actually rolled out a lot of what you call support mechanism for waste pickers and everything, just to ensure they survive the crisis. So when there is a crisis, what stand even an investor takes, and how quickly the yes came for a particular email to support the livelihood of people, is where it really shows, okay, what is the right part of it. So that's how I put it, as it has to match with the DNA.
I will agree.
And Anil, talk to us a little bit more about, when we were having our first fundraising conversation with each other, you kept talking about how you were really looking for an investor who would bring value beyond capital, and how you were looking for people to, have a company building approach along with you. So,
Right.
tell us a little bit about that thought process, and how should a founder try and find that value in their investors.
Right. So, so deciding on investor, I think this is uh, something which is good, which is a good thing. If you have choice, many cases you will not have choice, but if you have choice and you can choose among investors, then I think this is a good situation to be in. So when we were deciding, or we were in the fundraise process and we were discussing with you, uh, obviously money. If you had two, three investors, then everybody is giving money, and now you have option to choose, let's say, one of them. For us, important was that we have a vision for ourselves. Let's say culturally, let's say business wise, let's say profit wise, organization wise. We have a clear vision for ourselves. We have a current DNA, current culture, but we have a vision for the culture or DNA 5 years down the line also. That this is how we want to become. For example, uh, any organization starts growing from first employee, then it reaches a stage where there are 100 employees. Then there is a stage when we are maybe 500 employees and maybe 1,000 employees. So challenges for the company in terms of scaling at various stages are different. This is what uh, my learning is. When you have 10 employees in the company, then you probably want to run the company in a different way and different manner. You want to reward people in a different way. It's different, right? When there are 100 employees, then you change things in the ecosystem and you create a ecosystem which is productive and healthy for 100 employees. And accordingly, when you say 500 and 1,000, then you have to keep on making those changes with respect to scale, processes, systems. When you have 10 employees, there will be no process systems. At 100 employees, you will start thinking of them and building processes. And as you become 1,000 employee or more than 1,000 employees, then process systems matter a lot, right? So we had that clear vision, and we were the thought in our minds was that probably if someone can also guide us and help us on these challenges which we are going to face in our journey, then this is going to be a big value add for us. uh, One good thing about investors is that they have this vast experience. They have seen multiple startups at different stages. In fact, most of the funds, the leaders in the fund, they themselves have built multiple businesses. So a lot of experience is lying there with them. So our thought process was if we can get that kind of experience so that we know something in advance that okay, this is the challenge which probably we'll face when we have 500 employees, or if we have 500 employees and the other challenges, how we fix them in a quick manner. We will fix, but then it's going to be a learning curve. We are going to make mistakes, we are going to learn from them, but eventually we will fix it. So yes, Aditi, that was the thought that probably these kind of things are going to help us in future. May not be immediately, but when we start growing and in the long term, if we have these kind of investors with us, so building a large and scalable organization will be helpful for us.
And I hope you're able to find that value not just in Asha Impact, but
Yes, yes,
also
yes,
with
yes, yes, definitely.
run so many digital businesses. Um, Sandeep, Anil, I want to also talk about a very critical issue when it comes to social enterprises, right? Both of you talked about the fact that you faced rejection early on from investors, and now you've put yourself in a position of strength where both of you have multiple kinds of capital that's available to you. Sandeep, you started out as a niche waste management business, but today you're considered a large, successful infrastructure business, right? Anil, same for you, very successfully transcended from a small coaching center business to what is now such a large online business. One of the big glass ceilings we see social enterprises face is that they think of themselves as social enterprises and end up remaining niche, whether it is in their own ambition to scale or it is in being able to attract capital which is non-impact in nature. So how have you been able to transcend that boundary from being a small social enterprise to a large commercial business which delivers impact at scale? How much of it has to do with how the founder is viewing the business versus, let's say, an overall maturing of the ecosystem? So,
So I'll be very candid. So see, when you are small, you're always a social business. Okay, so your footprint is in one city or two cities. As soon as you go to more than two cities, you are a commercial business because your operation needs to behave in a certain way. And I think the perception changes as soon as you are from a one city small operations. So till we were about 70, 80 people organization, we were considered as small social enterprises. And we have reached to almost like 400, 300, 400 people, 500 people in one location in Indore. And totally we are about 550 people. So immediately you become a commercial enterprise where, you know, your scale is different, your presence in geography is different. So I think the perception does matter with respect to scale, with respect to being a social or a commercial one. And definitely, you know, as soon as you cross a particular scale where profitability or the top line and everything becomes much more interesting for commercial players to get in. So there is a barrier which is in the mindset of commercial investors. That is how I would put it as, because I think social investors or impact investors, they believe that it is good to get early in, help the startups to reach to a level and then grow along with that and evolve with them. So I think that's the difference between the investor psyche rather than more on the entrepreneurs, because entrepreneurs start an idea to make money and create wealth and make the right impact. But I think the financial sector has created that barrier that certain type of capital will only go at a certain stage of business where it is commercially positioned rather than as an impact position. That's how I look at it today. I might be wrong, maybe 2-3 years back, but today that's how I see it.
Got it. So your point being that if you have the ambition and if you demonstrate scale, capital will itself change its mindset of how they perceive.
And the type of capital also changes, because what I have seen is there was a time when debt was not available. People were very reluctant, banks were reluctant to do it, even private sector was reluctant to do it. But gradually, as your scale starts coming up, even though you were bankable earlier when you were small, uh, people were not ready to give you loans. But as soon as your scale starts becoming visible, different kind of financing mechanism also start becoming available. And that's where the larger capital, which you can be of a social impact nature but of a large quantum, is getting into play. So definitely scale is important, but how and when is something which every business needs to define on their own.
Anil, you deliver such a fundamental, value that you are democratizing the test preparation for students who may not have the ability to access, offline centers or travel to a different city to get to good quality educators. And you do that without naming yourself with one label or another. You have raised capital from both an impact investor and a large commercial venture capitalist like InfoEdge. So how do you see this sort of dilemma?
Right. So, Aditi, you're just before that you were talking of rejections. So, I want to just highlight a small incident on that. I think that will be very useful for budding entrepreneurs. So, 2016, we decided that our vision is to serve tier two, tier three, and we should go online. And we started looking for funding because we realized that we need to create huge infra, huge product, and a lot of things. So, we need to raise money. We did our analysis and we identified, let's say, top 50, 60 VCs in India, started meeting them and started getting rejections one by one, one by one. Met Sequoia, SAF, all, you name it. Incidentally, one of the most respected VC for us was InfoEdge. InfoEdge had funded Zomato, Policy Bazaar, they were doing really good. And we used to respect them a lot. And we somehow believed that they will be the best investors for us. So I talked to one of the friend, and somehow I got connected to Sanjeev, and I set up a meeting with them to present our case that okay, we are doing this, but we want to go there, and probably Info as will be the best investor for us, and they should invest in our business. So this guy who was my friend, he was able to set up a meeting, and we had a meeting with the whole investment team of InfoS, and including Sanjeev. Almost everybody was there. I presented it and rejected very well. I think within 10 minutes, they asked me to, they said, thank you, we got it. So you can leave now. So, and I was very, very disappointed. In fact, I almost cried and very disappointed. And eventually later on, then we somehow able to we raise small funding, Extra Light Technologies Limited invested. We built the product. We worked very hard. 3 years down the line, that is 2019, I got a mail from InfoEdge that they want to invest in our company. And then everything changes. Everything changes. And they invested. They forgot that we met them 4 years back. So I told them this when they were done with the funding. I had money in my account. I thought if they will get to know in between, I don't know what they will think. So the point is that when you get rejected, I think this is not end of the story. Somebody who is seeing you in a particular lens today, that will change eventually as you move ahead and you start working on your product. You start creating results. Things change for sure. I think this is one of the biggest motivator for me, this story which I am telling. One day I was very, very disappointed and I thought that these big VCs and institutional VCs, they are never going to invest in my company. because every time everybody had reasons. Somebody will tell me that, oh, okay, this is not good in your company. Somebody will tell me, okay, you are offline, so will not invest. Somebody will say that, okay, you are not tech, or your background is not this and that. They, all of them had reasons. But later on, inward interest and somebody with the intention to invest and eventually end up investing. I think that's big thing for any entrepreneur. So I think so. This is about reactions. So reactions come, of course, but if you are persistent and you know what exactly you are going to do and what is the value you are going to deliver, then things are going to fall in place sooner or later. In terms of value, I think in our case we were very clear because we chose education as a business, and it's very respectable business. I can tell you, even as on date, my old student, I used to teach those days in initial 3 4 years. uh, I used to teach a lot. So those guys come and meet and they even touch my feet. Even as on today, they are in jobs, they are in various positions. So it's something. So this is segment, especially in India, where education is valued the most, and especially if you help someone, and because of your help, somebody is able to get jobs, then they are not going to forget it in their life. See, so I think interestingly in our case, how it happens is that most of the cases, these guys, let's say tier two, tier three guys, they start preparing for job, but a lot of things are related to or linked to this job thing. So as soon as they will get a job, the next thing which will follow is their marriage, and then the whole journey, and this everything gets linked to that moment when they got selected. So I think we really enjoy this, especially serving the kind of audience we have and the kind of value we create for those guys and the kind of impact we bring in their lives.
That's so great to hear, Anil, that it's really the mission that keeps driving you, and the label really doesn't matter.
Right.
Uh, so we're nearing the close of our, allotted time. So, Sandeep, Anil would love to hear from you on what would your advice be to startup founders who are just starting their fundraising journeys. What are the mistakes that you think you possibly made in your fundraising journeys in the past, which you would advise people to do differently, or just what should they focus on in the initial years? What would your advice be to us?
See, my point to most of the entrepreneurs would be focus on your product or service. Don't go and try to raise money. Go and share about what problem you resolve for your end consumer who is going to pay for it. And I think that size, scale, and what is something which is unique about you, if you are able to highlight that to any investor, they would love it. Definitely, if they don't invest at a particular time, where like Anil said, they would come back at one stage of your life where you become the right fit. So it is important that you what you believe in, and you will have a lot of rejection. My business was built from 2006 to 2008 9. I used to go meet a private equity, used to tell me why they would not invest in me. Okay, so I have a great respect for others. I do mention the name. It was known as Alloy Private Equity at that time. They used to tell me, and they were only environmental private equity. And because I was looking for a smaller size, they would say, it's not, but they would tell me why they would not invest in me. And I would go back and, think, how am I going to solve this problem, and keep on solving those problems. When Android was launched, it was my eureka moment. Okay, so in my life, I remember that day, somewhere in August 10th, in Times of India, right hand side bottom corner, the ad for Android launch had come with a tablet of 12,999 rupees. That's a picture in my head still, which was my eureka moment, where I could build a tech platform where the transactions can happen, which could bring transparency and trust with the customer. So that is something which some people do. So rejections are something you should get used to, but take those rejections as why. Figure out that why and get those answers, and I think your product will get better. It is not necessary to get answers for all the whys, so please also be very careful. Okay, don't try to perfect the product. Be ready with 70%, 80%, go out. Because if you had 100% right, then you would be making revenues and not looking for a VC. So you need funding because you want to make it from a particular stage to somewhere different. that's where that funding would be required. So don't go out to raise money and just use that money for marketing, but to maybe build the product, build the skill. That's what I would advise.
Right.
Very useful advice, Sandeep, since we also had a lot of people asking us, how do you deal with rejections and how do you keep going? So I think that building resilience as a founder is so critical.
I have seen days, means I've slept very sad because you remember I mentioned 68 people saying no. The amount of people Anil had listed down 50. I got 68 rejections before I even got a first copy. So definitely, and plus, the business challenges being apart. So I was ahead of the time where the waste was not being looked at. I was reading one of the questions where a lot of waste management companies will be coming into play, and I think there are many coming. So I think rejection is something which people need to get used to. As entrepreneur, definitely.
Right.
Anil, what about you? What have you learned from this journey and mistakes that you hope future founders would avoid?
Right. So I think the biggest thing for an entrepreneur is to be fearless. Means if you really believe what you are going to do or what problem you are going to solve, it's going to be tough, and you have to have a lot of courage in the journey. If you are not that kind of person who can manage any kind of setback, then probably all kind of setbacks are going to come. So, so my suggestion to entrepreneurs is that when you are thinking of entrepreneurship, it's going to be so a lot of ups are also going to be there, but everybody likes those. But a lot of downs are also going to be there. But if you are thinking big and you want to create really something long lasting and large business, then be fearless. You have to be aggressive, and you have to have a lot of courage in the whole journey. When you are going for fundraise, then I will suggest that most important part is that you should have very clear plan to the minutest possible detail, which should also include your expenses, revenue, and everything. Plan matters a lot. If you have any plan, because when you meet investors, and let's say even if they reject you, take you are going to get feedback from those guys, and based on the feedback, you can keep on refining your plan wherever you feel like. You should have that clarity in your mind. But VCs would be very interested to see your plan, what exactly it is, and your aspiration also in that plan. Means ultimately what you want to achieve when you make the plan. For example, you are making a plan where you are saying that, okay, today my revenue is 10 crore, and let's say 5 years down the line, it's going to be, let's say, 15, 16 crore. So that shows your aspiration. Maybe some investors might be okay with that in terms of returns, but that in terms of aspiration, in terms of thinking big, so that's not enough. And again, as I said, the plan to the last minute possible detail, that helps a lot for any investor to make a right call and quick decision. And secondly, your vision. Of course, team you will have when you will approach. Team is the other thing uh, for investors, which matters a lot.